While markets traded last week and headlines focused on tech stocks and interest rates, a quiet revolution began unfolding in the global banking system. On July 1st, 2025, Basel III regulations took full effect in the United States, fundamentally changing how banks must treat precious metals on their balance sheets. This isn't just another regulatory tweak. This is the most significant restructuring of the relationship between banking and physical assets since President Nixon severed the dollar's link to gold in 1971. And most investors have no idea it's happening. Today, we're diving deep into Basel III, what it means for gold, silver, the banking system, and most importantly, your financial future. Because whether you own precious metals or not, these changes will affect your wallet, your investments, and the stability of the entire financial system. Understanding Basel III. Let's start with the basics. Basel III is the third iteration of international banking regulations designed to prevent another 2008-style financial crisis. The Basel Committee on Banking Supervision, an international body of central bankers, created these rules to ensure banks hold enough capital to weather economic storms. The regulations were initially published in 2010, but implementation has been gradual. The United States only began full compliance in July 2025, with a 3-year phase-in period extending through June 2028. Here's what makes Basel III different. It dramatically increases the amount of capital banks must hold against risky assets and introduces critical mechanisms like the net stable funding ratio and stricter definitions of high-quality capital. According to PwC estimates, globally systemically important banks will experience capital requirement increases of approximately 21%, while regional banks face around 10% increases. That's not a small adjustment. That's a fundamental restructuring of bank balance sheets. The gold reclassification that changes everything. Now here's where it gets interesting for precious metals investors. Under Basel III, physical gold held by banks has been reclassified as a Tier 1 asset with 0% risk weight. Gold is now treated the same as cash and U.S. Treasury bonds for regulatory purposes. This is enormous. Previously, banks could only count gold at 50% of its market value toward their capital requirements. Now they can count it at 100% if it's physically allocated and unencumbered. But here's the catch. Unallocated gold, the paper claims on gold that don't represent actual physical metal, gets treated like a commodity. Under the net stable funding ratio, banks must secure stable funding equal to 85% of their unallocated precious metals positions. Think about what that means. For decades, banks have been able to create paper claims on gold cheaply and easily. They could sell gold they didn't own, manipulate prices through futures markets, and treat these paper positions as if they were real assets. Basel III just made that prohibitively expensive. The end of paper leverage. The precious metals market has operated on massive leverage for years. According to testimony at CFTC hearings, the paper-to-physical ratio for silver stands at approximately 300 to 1. For gold, it's around 100:1. That means for every ounce of physical metal in existence, there are 100 to 300 paper claims on that same ounce. This system worked as long as everyone didn't demand physical delivery at once. Basel III just changed that calculation. When you make it expensive to hold paper positions, banks have two choices: buy physical metals to back their paper claims or exit the market entirely. The cost implications are staggering. Maintaining short positions in precious metals now requires banks to hold 85% of that position value in stable funding. For a major bank with billions in paper positions, that's billions in additional capital they must set aside, capital that could otherwise be deployed for lending or trading. Central banks saw this coming. Here's the critical detail most people are missing. Central banks saw this coming. From 2022 to 2024, central banks purchased 3,220.2 tons of gold, more than double their purchases from 2014 to 2016. In 2024 alone, central banks added 1,044.6 tons to their reserves. Why the rush? According to market analysis, the sharp acceleration began after the seizure of Russian reserves following Russia's invasion of Ukraine. Countries with less geopolitical alignment with the West suddenly realized their dollar reserves could be frozen or seized for political reasons. Gold cannot be sanctioned. Gold cannot be printed. Gold cannot be seized electronically. China has been particularly aggressive. Eastern central banks have been operating with physical metals for years, while Western institutions relied on paper derivatives. Basel III represents the West finally catching up to what the East already knew. Physical trumps paper in a crisis. The short squeeze scenario. Here's where things get potentially explosive. Many major banks hold large short positions in precious metals markets. When Basel III forces them to either buy physical metal to cover these positions or exit the market, we could see a classic short squeeze, a self-reinforcing cycle where forced buying drives prices higher, which forces more buying. 8 major banks paid $1.3 billion in fines during 2008 to 2016 for systematically manipulating precious metals markets. Now the regulatory environment has shifted to make those strategies far more expensive. We're already seeing evidence in the market. Gold reached an all-time high of $4,642.71 on January 14, 2026. JP Morgan forecasts gold averaging $5,055 per ounce by the fourth quarter of 2026, with prices potentially reaching $5,400 per ounce by the end of 2027. Morgan Stanley revised their 2026 forecast upward to $4,400 per ounce, an additional 10% gain from current levels. Silver's amplified impact. If gold is interesting, silver is potentially explosive. Silver faces the same 85% funding requirement under the NSFR, but remember, silver's paper-to-physical ratio is 3 times higher than gold's. That's 300 paper claims for every physical ounce. Silver also faces industrial demand that gold doesn't. Companies like Tesla and Samsung need physical silver for electronics, solar panels, and batteries. When banks exit paper positions and industrial users compete for the same shrinking pool of physical metal, you create a supply crisis. Historically, silver prices track gold with higher volatility. When gold moves 10%, silver often moves 15 to 20%. If gold reaches $5,000 per ounce as forecasted, silver could see proportionally larger gains based on historical correlations. What this means for investors. Several clear implications emerge for your portfolio. First, physical metals are fundamentally different from paper contracts. An ETF or futures contract is a claim on metal, but it's not the metal itself. Under Basel III, that distinction matters more than ever. Second, the supply-demand dynamics are shifting dramatically. Central banks, sovereign wealth funds, and now commercial banks are all competing for physical gold. Goldman Sachs forecasts gold reaching $4,500, while more aggressive analysts suggest $5,000 to $6,200 is possible by 2030. Third, timing matters. Major institutions are positioning now before full Basel III implementation in 2028. Waiting for prices to come down might mean waiting forever if structural supply constraints emerge. Fourth, diversification remains critical. Even if you're bullish on precious metals, they should be part of a balanced portfolio. Gold generates no income. It doesn't pay dividends or interest. Its value comes from capital appreciation and crisis insurance. Here's what we know with certainty. Basel III regulations have taken effect. Physical gold is now a Tier 1 asset. Paper metal positions are now expensive to maintain. Central banks are buying aggressively. The largest banks in the world are repositioning their balance sheets. The era of unlimited paper leverage in precious metals markets is ending. Whether you view that as an opportunity or a threat depends on your positioning. Those who understand the structural changes happening now have the advantage. This isn't about predicting the exact price of gold next month or next year. It's about understanding that the rules of the game have changed. The 85% funding requirement for unallocated positions isn't a theory or a proposal. It's reality as of July 2025. For decades, critics argued gold was a barbarous relic. Basel III suggests international regulators disagree. They're treating physical gold as the highest quality asset a bank can hold, equivalent to cash itself. The transition period through 2028 will be critical. Banks will adjust their balance sheets. Credit conditions will tighten. Meanwhile, gold and silver will likely continue their structural bull market, driven not by speculation or fear, but by fundamental changes in how the global financial system operates. The era of physical metals has begun. The era of paper leverage is over. Position accordingly.